you need to find a mentor or somebody that has been there, done that before you, and find a way to work with them, partner with them, find a way to add value to another experienced developer to help you look into your first development deal.
Welcome to Multifamily Insights. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. Listen, if you're getting some great value from our conversations, I'd love for you to do me a little favor, but it's really not for me, it's for our audience. Leave us some honest feedback with the rating and review. It helps other listeners find this show and understand what kind of quality content they're going to get when they check out these episodes. Listen, if this is your first time checking out our show, or you're an avid listener, make sure you follow or subscribe so you don't miss an episode. Now, we've got a great show today. We're bringing on a friend of mine, Mr. Justin Goodin. Hey, before we jump into today's show, I want to tell you about a transformational event that's taking place in April. It's called the Real Estate Wealth Builders Conference, and it's being hosted by my buddy, Dustin Heiner. Now, I had the pleasure of attending this event last year, and I got a chance to network with some amazing speakers. In fact, there's going to be 40 plus speakers at this year's event, including yours truly. So listen, if you want to join us and transform your life, go to rubcon.com and get your ticket today. You can use my name, John, as your promo code and save 10%. Now, this event is for both seasoned investors and new investors, so all who are serious about taking their investing to the next level are welcome. Again, just go to rubcon.com and use my promo code John to save 10% on your ticket today. And I'll see you there in St. Louis. Justin Goodin is the founder of Goodin Development, a multifamily development firm that enables busy professionals to invest in real estate without the demands of being a landlord. Now, Justin's journey is one of transformation and calculated risk. Starting his career as a multifamily underwriter at a bank, he quickly realized that the most significant financial benefits of real estate were on the investor side. Let's welcome to the show, Justin Goodin.
Thanks for having me on, John.
Absolutely, Justin. Great to have you on. I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Of course. Well, yeah, as you mentioned, I'm a multifamily developer here in Indiana. We focus on building Class A market rate communities in and around Indianapolis, Indiana. And yeah, it didn't always start like that, though. I got started in real estate like most people, wanting to earn passive income on the side. And what led me to that is starting in rentals and fix and flips. And I think most people get started in that, or they take that route down the flips and fix and flips and rentals, because that's like the first thing that we think about when we want to get into real estate. So that's what I did. I started buying rentals, fix and flips in and around Indiana. And after graduation, where I got a degree in finance from a business school here in Indianapolis, I knew I wanted to go, bigger, faster into commercial real estate. And so I thought the perfect job would be working for a bank as a multifamily underwriter. So I did that for a number of years, underwriting loans for a bridge lender, kind of see how sponsors evaluate deals, how they underwrite properties today. All that was really awesome experience for what I do today. And so I left my W-2 job about 5 years ago to pursue real estate, apartment investing full time. Started out doing a lot of value add, existing syndications on multifamily properties, and then scaled up into multifamily development, which happy to talk about more in this show as well.
I love it, man. Justin, the thing I love from your story is the intentionality of some of the steps you've taken, right? So you mentioned that, you were interested in real estate. You started fixing and flipping like many other folks who, when you're exposed to real estate or you think about real estate investing, it's usually, being a landlord, through some small rentals or fixing and flip. So that's exactly what you did. You got your degree in finance, got a job at a bank. But I love the fact that you were kind of intentional that you wanted to scale into commercial real estate. So you thought a bank job would be a great avenue for you to learn more. So that's what you did, right? You earned while you learned. You got paid, a nice salary to learn how to be better in this business. Eventually, you go full time on the real estate investing side, focusing first on value add multifamily before transitioning into the development side. Let's go back to the bank, right? Because I know you do a lot of underwriting as well. You've got an underwriting product that you offer to some of your clients as well. Talk to me about just the process of underwriting. What's your process and what are some key things you're always looking for? You're kind of teaching people to watch out for whenever you're underwriting an asset.
Yeah, where to begin? I think first and foremost, I just try to make my analysis as realistic as possible. I think the word conservative gets thrown around quite a bit in this industry. but it's like, what does like conservative actually mean? So I just try to like and narrow down what that actually means and incorporate that into my analysis. So I mean, I want my underwriting model to be as realistic as possible when I'm making these projections. I do that by like under promising and hopefully over delivering. So that looks like projecting rents that I think are maybe slightly below what I think are actually achievable in that market. Maybe projecting rent growth that is 0% for the first couple of years, and then 2 or 3% onwards after that. Maybe like a tax number, projecting a tax number that's 5, 10% higher than what you actually think is going to happen once your or if your property gets reassessed in the future. So I mean, just doing numerous things in your model to sort of like under promise and over deliver to your partners and to your investors, I think is really key.
I love the way you talked about, that word conservatism because it is thrown around a lot, and that is always subject to the eye of the beholder. But I like the examples you shared, right? Looking at rent growth and making sure that you're modeling maybe 0%, maybe 2 to 3% for the years down the road once it's stabilized. Taking a look at the tax reassessment, make sure you understand what that is, and maybe even projecting higher tax reassessment than what's realistic. And then also just understanding what your rent opportunity is, what your rent growth is, your rents, and make sure you understand where the market dynamic lies. Um, when you look at how other folks underwrite, whether it be from your time back at the bank or just as an investor yourself, is there a specific line item that you see people make mistake over and over and over?
Yeah, I think one huge one is to be capex or capital expenditure costs. I think kind of under budgeting what things are actually going to cost in the real world, like after you close on the property. So definitely get like a third party bid from a construction company or a contractor to kind of firm up your bid while you're under contract or while you're buying a property. But yeah, I mean, costs are, I think as we all know, are not going down and are always like increasing over time, whether that's material costs, labor costs. So I think like just getting like an accurate bid, extremely accurate bid from a real contractor is going to be your best bet to firm up your numbers before you buy the property. And also, I mean, just budget for contingency reserves. I mean, expect like the unexpected. So do things to make your budget a little bit more, you have like some more buffer room before you actually buy and close on a property.
And did I hear you correctly that you started off with the eye on being passive before kind of transitioning to being an active on the value add side?
I have not. I mean, I've invested
Okay,
passively in my own syndications, but yeah, I did not start off as a
got
passive
it.
investor and then move
Okay.
into the active side.
So I want to talk about the value add because, right, one of the things that you've done is you've kind of transitioned from being a value add investor to a developer. And I'm curious of that journey. Like, what led you to say, hey, you know what? I want to go from finding existing assets and finding ways to create value within this existing asset to building something from the ground up. What was that process like?
Yeah, for me, I think the biggest thing or biggest reason why I switched from buying existing value add assets into doing ground up multifamily development is like the sheer amount of competition in the value add space. I mean, of course, there's still competition on the development side as well, but I think there's just a tremendous amount of competition in the value add space. I mean, as you know, there's just so many different companies looking for the same kind of asset, which I think in return drives up competition, drives up demand, increases prices. For me, like I went like an entire year without finding a really good, kind of conservative value add deal. And so I just think like on the development side, I'll be able to do more volume, more deals, because I think there's a lot less developer, a lot less, investors willing to put in the first 6, 8, 9 months on a development project to get it started. So I think I'll be able to do, more deals, more volume on the development side just as a whole of my business.
Yeah, so sounds like, you like the value add model. There was just so much competition where you weren't able to
Yeah.
find or buy deals at a price point that made sense for you, which led you to look at other avenues and ultimately into development. For people who are in those shoes, right? And scouring for that value add multifamily deal, can't find one that pencils out, whether it's because of the underwriting or whatever reasons, just competition in general. If you're thinking about making that transition, what's something every investor needs to know before they consider development?
Well, I mean, I think development is actually 10 times harder. So I think if you're going to get into development, you need to find a mentor or somebody that's been there, done that before you, and find a way to work with them, partner with them, find a way to add value to another experienced developer to help you look into your first development deal. Because there's so many different parties and different companies a developer is working with or working over to all like come together to do one thing and one goal to build a project. So to get people to take you seriously, to help like upfront cost, to know what's right, what's wrong. I mean, similar to the value add space, but I think you really need an experienced partner or mentor to help guide you through that process so you don't make some really costly and damaging mistakes.
Which I think is true for, all commercial real estate, right? If you're new, having a partner who's experienced, having a mentor, it's vital. I mean, certainly you could try to figure it out for yourself. And maybe you're
Exactly.
going to have
Yeah.
success. I think the point you're making is, at least with the existing assets, you've got a, trailing 12 months of operations you can look at and see how the property is already performing and hopefully have a business plan where maybe you can increase that value. But when you're doing development, you may not even know what approvals are needed and what the next step in the process needs to be and, getting the city, zoning approvals and all those kind of things. So you just may be completely lost to the point where you could completely derail your investment. So talk to me more about maybe that acquisition process because most investors, we start there, right? Like we got to buy the land, we've got to get it entitled. So walk me through what it's like to acquire an asset or acquire land for development.
Yeah. So for me, I'm like starting with one thing, and that's finding the absolute best location in the best possible market. Like it doesn't matter how good of a deal or the market is or this or that. Like I think it all starts with building in the best possible location. So the location is absolutely the number one criteria that I always look for. If I find an awesome location, then I just try and like reverse engineer from there. Like it could be a vacant piece of land, it could be an old or blighted building in the area, but I am focused on finding the best possible location in a thriving market as well. So after I find the right location, I want to get the property or get the land under control. So I'll make an offer with the owner, seller, whomever, and do what I can to actually get the property or get the land under contract, under control. That's another key distinction because you can make speculations about what you're going to build. You go talk to the city, you can go talk to your partners, but if you don't have the land under control, under contract, then it's all just speculation. It's all just guesswork because nothing can happen. So right location, get the land under control, and then you can just work towards getting the proper zoning on the land, which could take depending on the situation, the city, 3 6 months around the time to get it properly zoned. During the time, you can talk with your civil engineer, you can talk with your design team or your architecture team to build or formulate a compelling project. So that includes, getting a site plan done, checking on utilities, figuring out how many units can fit on this exact location. So you're doing all that like while you're working through the zoning process, while you're working through approvals, and once you have all that, kind of like set in stone, you have like your site plan, you have the renderings done of what the property can look like. Then you can go to the city, pitch them this compelling project. Go to the RDC or redevelopment commission to go for approval. So there's a lot of work that you can do, while you're under contract, and then depending on your timeline when you have to close on the land, you can already have a good amount of confidence that your project is going to get approved by the city and go forward before you actually purchase the land and take on that risk as well. So, upfront, that's like easier said than done, but that's like a lot of the legwork up front that has to happen before you get approved, before you close on the actual land and project.
Yeah, I love it. You talked about one, getting control of the land, right? Getting it under contract, getting control of land. You can have all the conversations you want prior to that, but the reality is you can't get the ball rolling until you get control of the property or control of the land. From there, you're going into zoning, you're talking to the redevelopment commission, and you're trying to talk to your team, getting the architects together and really mapping out what does this project look like and then presenting it to the city. What's the time frame from, getting that property under or getting the land under control, as you mentioned, to actually closing on the land? Because I know you mentioned maybe 3 to 6 months just for zoning. So, how long are you under contract before you actually close on this piece of land?
Yeah, I mean, of course, it depends on the unique situation and what's going on. Of course, it depends. But I mean, just to give you an idea, like our current project that we are breaking ground on April in 2025, I made the first initial offer on the project back in June of 2024. So made the offer, got it under contract, and then from there, we've just been working towards rezoning approvals, working with the city for incentives, things like that, going back and forth with our architecture team. We closed on the land in December of 2024, and now we're planning to close on the construction loan and break ground in April of 2025. So that's they don't always have to be that long. You could quite literally start a project probably 4 or 5, 6 months after you have the control of the land, depending on the zoning and how quickly the city moves. But yeah, I know it's a broad answer, but it kind of just depends. But hopefully that last one gives you a good idea of what it could look like.
No, and that's what we're looking for, right? I mean, again, for most people, their frame of reference is buying a house or buying even a smaller or large multifamily, which could be a, 30, 60, 90, maybe on a long case, 120-day
Right.
closing process, right?
Yeah.
And you're describing a process that is much longer just to close on the land. And then obviously you
Right.
have the entire construction component that comes into play. So, end to end, just again, speaking in generalities, from the time you go under contract on the land to the time you're able to get that certificate of occupancy, what's the range investors should expect?
Yeah. So let's say on the pre-development side, just doing the land contract, getting your project approved. Let's say anywhere between 3 to 6 months, maybe to actually close on your construction loan. After that, after you're like fully approved and entitled, another 3 months to build the project. Again, depending on the size, but we'd say anywhere between 14 and 16 months to build the project. Another 4 to 6 months to stabilize it, lease it up, stabilize it, get it cash flowing. That is like more of a general kind of time frame, start to finish. So maybe 2, 3 years around that time frame.
Got it. No, I appreciate you sharing that. So, I mean, the question most listeners are going to be asking themselves, like, okay, sounds like a lot of work, a lot of patience, a couple years before we actually have anything that's generating a dollar out of this investment. Is it worth it? So like, how do the investing returns compare to maybe buying those value add or existing multifamily deals?
Yeah. So I think, to compensate to the investors that you're not earning cash flow along the way during the construction process. I mean, us personally, like at my company, like we don't get investors involved during like the entitlement or like rezoning phase. Like once we have like a project fully approved, shovel ready, ready to go, then we start raising capital. But we don't raise capital for like any kind of upfront cost or put that at risk. Um, but yeah, I think to compensate for their like no cash flow or no returns during the construction period, that returns should be higher. So we look for projects that can generate around a 19, 20% at least IRR to limited partners over 3 to 5 years. Um, so investors can expect to like not earn any cash flow during the construction period, obviously, but they are still earning that preferred return all through construction. So we close on the project. It takes 14, 16 months to build it. Investors are still earning that preferred return day one all through that period as well. And like we're working with investors that are more interested in like really just multiplying their equity as quickly as possible and not so much concerned or that they need a cash flow return year by year. I mean, that's always nice, and it happens once the project is leased up, stabilized. But for us, like we're looking to build these properties, lease them up, and then sell them as quickly as possible, and really just multiply and our investors' equity as soon as we can, and not hold on to these properties long term. So a lot better suited for investors that are just looking to multiply their equity as quickly as possible.
Yeah, I appreciate that. And you talked about, investors kind of earning those returns or that pref return day one. You're talking about that being accrued, right? So it's not that you're going to get the distributions right away, but they will accrue. So that ultimately that will be paid once the property is starting to generate income. And it sounds like, and I think it's important for people to understand, The kind of investor who would like a deal like this is the kind of investor who's looking for wealth accumulation, right? Longer term appreciation. Not that you need to be in this deal, for 10 years, because your vision is buy it, stabilize, buy it, build it, stabilize it, sell it. So you're looking to really sell it, once that thing is kind of stabilized. But you're not investing in this for cash flow. You're investing in this because once you have a stabilized asset, it's going to be worth a lot of money. You're going to be able to sell it and deliver strong returns for investors. Obviously, when we're talking about returns, we're talking about projections. Nothing's guaranteed. Every deal comes with a level of risk, but that risk adjusted return is important to understand too, because development does have more risk innately involved in it. Those returns are projected to be a little bit higher because there's more that goes into it. So certainly something worth exploring if you have a longer investing time frame, meaning that you don't need the cash flow right away, but you're looking to, really grow and kind of expand your capital over the next few years. I would love to just kind of stay in this space and understand more about, again, value add versus development, because when we think about value add, we're typically looking at a combination of cash flow and depreciation over the life cycle of that investment. When it comes to development, you're really focused on just the appreciation component of building an asset from scratch and then having this payout at the end. As you think about kind of pros and cons between value add and development, what are some other key differentiations that you would want to call out?
Yeah, thank you. I think, the pros on the development side, I mean, a couple of things that I think we do to mitigate risk that I have not seen done or possible on the value add side. One is that, with our construction company who builds the actual project, we have something called a GMP, or a guaranteed maximum price. So that is our contracted budgeted price, or with the construction company, that says, hey, this is what it's cost to build. If it goes above that contracted price, the contractor or the construction company is actually on the hook for the overage. So that is not something that the developer or investors will have to, take the risk on. That contracted price is what we pay to build the project. And if it goes over that amount, the construction company actually picks up the overage and not us. Another thing that we do that not all development companies do is, we partner with different municipalities to build these projects. So what it looks like is that we actually, go to the city or go to the town and present a very compelling project to them. And we find ways to, build this really, beautiful project and get the city to partner with us to build that. That looks like with them, like they actually inject money into the project to make it market feasible for us. So we all know construction costs are rising, interest rates are rising, which in return makes these development projects really difficult to get the pencil out unless the city or the town wants to invest in this project. So in return, they're getting a nice, beautiful project that otherwise would not be feasible to build because of the market conditions. In return for us, we're getting a project that is market feasible. It also like lowers our basis on the project. So there's some, pros and cons with value add and development, but those are, a couple of things that we do to sort of mitigate risk and make it unique from a, standard traditional value add deal.
Yeah, I love it, right? That public-private partnership to kind of reduce your basis, working with those cities, working with those towns for different incentives, definitely a smart way. And it's something we see, in the development space, because it is one of the ways you're able to get those development deals that are coming to fruition. The other thing you talked about was that GMP, the guaranteed maximum price. Therefore, if prices do kind of go up, you're not taking that on as the investor. Really, that contractor or that developer, the construction company is really eating those differences. One of the things that's happened more recently is there's been a big push on, hey, they're going to be tariffs, our price is going to go up, and a lot of concern on the cost of materials. How do you kind of factor those market uncertainties into your development process?
Contingencies. We always have a set contingency or buffer amounts in that development cost, and that kind of allows us to weather the storm along the way for if or when things like that do pop up. I mean, of course, you can't predict the future, what's going to happen 3, 6 months from now. But we always have like a very sizable contingency amount in all construction projects that we do.
No, I love it. Justin, for folks who aren't as familiar in this space, right? Some of the terms seem interchangeable, but I know they often mean specific things. So like a term like builder versus developer, I know is very nuanced and means different things. Can you just explain the difference between kind of the builder and the developer when it comes to the development space?
Yeah, so the builder, or I guess you can call them like the construction company. I mean, this is a company that the developer hires to build the actual project. The developer, you can think of them as kind of just like at the top of the food chain, if you will, but they're the ones like overseeing the construction company, the architect, the civil engineer. They're talking back and forth with the city. They're arranging the financing and talking to the bank. So the developer is in charge of managing all these different third party companies to come together to that one goal and build the project. The construction company is quite literally the builder. They're building the actual property, they're hiring the subcontractors, they're managing the construction progress as well. And as a developer, we're really just like overseeing them and managing the budget from a high level.
Yeah, I love it, right? So for our investors who have done fix and flips or value add, the developer is basically the investor, right? It's you're the one calling the shots. You've got the equity in this deal, right? You're the one who is highly vested in this operation. The builder is pretty much the general contractor who is working with the subs to get everything there. But as that developer, you're touching every piece of this. You're working with the city, you're working with the architects, you're working with everybody who is involved at any point within this process to make sure this development comes to fruition. So just make sure you understand the kind of the difference in kind of some of the nomenclature because it can get confusing, once you start listening to different folks or trying to understand what's happening with the deal. It just helps to understand some of that terminology. What's something else that you get from investors, right? You're talking to investors all the time. Maybe many investors are, have never invested in a development. What are some of the common questions you get from those investors?
Yeah, I think it's like one thing, the common thing is always what we just mentioned, but what happens if costs go over budget? What happens if costs increase while we're under construction? Um, what happens if the lease up takes longer than usual? All that just goes back to, how confident we are in the market, how confident we are in our projections, and all that buffer room that we have in our budgets. So we always have like interest reserve, and that's just money set aside to help us pay the mortgage while we're leasing up and not stabilized. We always have like operating reserve. That's to pay for like marketing, property management costs, things like that while we're leasing up as well. And I mean, just like actual regular contingency. Like if and when something happens, like we have a set amount of money in our budget to plan for those unexpected costs that may arise along the way. But yeah, I think our business plan and how we're partnering with the city, how we're getting like that partnership with the city, which in turn like lowers our basis. We have like a really like low loan to cost. Every project I've done, we've always done fixed interest rate debt. Even on construction loans, we've done fixed interest rate debt. A combination of all those things is kind of how I help investors get more comfortable with development. But I don't feel that our business plan and how we're building properties is like your typical extremely high risk, high leverage construction properties. It's a little bit more unique and a little more nuanced than that.
Yeah, I appreciate you sharing that, right? And especially when you talk about the loan and the financing, 'cause that's certainly a question for every deal. And we certainly know deals that have had loan or interest rate challenges over the last couple of years. So important to understand how you approach that. You mentioned kind of the market, and again, everything comes down to looking for the best market for the best deals and or best location in the best markets is what you said earlier. Is there anything different that you look at or utilize when it comes to looking at locations and markets for development that you wouldn't necessarily pay attention to or you don't prioritize as much when you're buying an existing asset?
Yeah, I mean, for us, I think we're looking at all like similar metrics to go by, and then on the development side, we're looking for supply constrained markets. So if there's been five other new apartment deliveries in the past year or two. We have to do like some really in depth analysis to see what is that demand like in that market after those other properties came online? So, yeah, like we're looking for supply constrained markets where there's a huge demand for housing, but not enough supply to, meet that demand. Other than that, we're looking for the standard, metrics, job growth, population growth, landlord friendly areas, all those things to, help us go in the right market. But again, going back to that actual awesome location in that more specific market as well.
Love it. You mentioned that your business plan or your focus is stabilize and sell. Is there a reason, or can you give us some context of like why you look to sell as opposed to stabilize and just hold it for 5 to 7 years?
Oh, great question. Yeah, for me, like, I love development. I want to become an expert in one thing, and that's being a multifamily developer. I think like anything that takes my focus away from doing that is, taking my focus away from my competitive advantage. So, as you know, like the asset management side and holding on to properties is just like a whole other business, a whole other beast on its own. I want to, sell that property and then move on to the next project. I want to take my expertise, my focus, and keep doing what I know and what I enjoy. Um, the second reason is that, I think when you sell the property, when it's, freshly leased up, brand new property, brand new asset, appliances, et cetera. It's extremely attractive to a new buyer coming in to purchase that asset. They have top market rents, a brand new property, presumably less repair and maintenance issues, better quality tenants. It's a very desirable and competitive asset to the next buyer, which in return gives us a very, compressed cap rate, a very competitive purchase price, ultimately, just driving those returns to our investors.
I love it. Well, Justin, great information. I appreciate you sharing a little bit more about your journey there. And for folks that want to learn more, you can go to goodindevelopment.com and learn more about some of the projects Justin and his team are working on. Right now, we're going to transition to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the apartment investing mastermind. Just go to casmancapital.com and click on the mastermind button today. Justin, give me a failure or an apparent failure that set you up for later success.
Yeah, I think a failure that I didn't do when I started in real estate was like not posting on social media. So I spent a long time, like when I was getting into real estate, not talking about what I do or what I want to do in real estate on social media. So since then, I've built some pretty, really good social media platforms on LinkedIn, Facebook. I think it's so valuable to talk about what you do on social media because that's going to attract you to other partners, other investors, brokers, lenders. It makes you appear like more credible in the marketplace. And you never know, like where one conversation is going to take you. So I think just having that credibility and that presence online is absolutely critical.
Give me a digital or mobile resource you recommend for our listeners.
Yeah, of course, today it's going to be ChatGPT. So I use the app to respond to emails, help with social media posts, things like that. Help craft responses and things like that. ChatGPT is just an amazing app. I use it on my phone and computer and things like that today.
Give me the book you've recommended or gifted the most in the last year.
I'd recommend Stay Sane in an Unsane World. Awesome book about mindset. It's written by the kind of mindset coach from Tom Brady.
Love it. All right, give me a daily habit that helps you stay focused on your goals.
Exercising. Doing some form of physical exercise every day. It doesn't always have to be like hitting the gym. It could be a simple walk every day. But just doing something to stay active, keep your mind clear, stay healthy is what I do every day.
Give me your number one insight or development.
Having a great team, having a great partner, a great mentor, having a great lender, it's absolutely a team sport. It's not done alone. So I think surrounding yourself with people who know what they're doing, who are experienced and trustworthy will really help you out with your success.
All right. You are in the Indianapolis area. Give me your favorite place to grab a bite to eat.
Julia Tacos downtown, really authentic taco place downtown Indianapolis, amazing place.
Julius Tacos it is. Listen, you gave us some great stuff, Justin. Loved hearing more about your journey coming from the financial side and banking, really starting with the fix and flips, recognizing you want to scale into commercial real estate. First focus on value add multifamily, transitioning now into new development deals, and just talking to us about some of the things to pay attention to, how important location is, specifically when it comes to development, but also recognizing that the time frame's a little bit different, a little longer. You want to make sure you get control of that asset before you get all the approvals moving, and also recognizing that, hey, when it comes to your business plan, you like to get in there, build the asset, stabilize it, and then sell that asset. And also recognizing just how important it is to have the right people around you, building the right team, having a partner or mentor that has that experience. That's just going to help ensure you have more success. I appreciate everything you shared there. And also, you talked about underwriting at the beginning of our conversation, just understanding what it means to be conservative and building in those realistic expectations. So, appreciate giving us all that information. For folks that do want to learn more, they can reach out to you at goodindevelopment.com. We will link to that in our show notes. Justin, thanks again for coming on the show today and being a great guest. We look forward to staying in touch with you, and I hope you have a great day.